financial system, enhance ease of doing business, and improve consumer protection. At the same time, we approach the new year with hope, vigor, and determination to further support the economy and accelerate progress. Since the October policy, the Indian economy has witnessed rapid disinflation, with inflation coming down to an unprecedentedly low level. For the first time since the adoption of flexible inflation targeting, average headline inflation for a quarter at 1.7% in Q2 this year breached the lower tolerance threshold of 2% of our inflation target. It dipped further to a mere 0.3% in October 2025. On the other hand, real GDP growth accelerated to 8.2% in Q2, buoyed by strong spending during the festive season, which was further facilitated by the rationalization of the GST rates. Inflation at a benign 2.2% and growth at 8% for the first half of this year presents a rare Goldilocks period. Globally, contrary to earlier expectations, growth has been relatively strong. Evolving geopolitical and trade environments, however, continue to weigh on the outlook. Inflation paths remain divergent, with headline inflation remaining above target in most advanced economies. Pressures in most emerging markets, however, are contained, providing them the room for accommodative monetary policy. Conflicting pulls and pressures from AI-fueled optimism and concerns over high valuations are playing out in global equity markets. Divergence in monetary policy trajectory of central banks is adding to the uncertainty on the capital flows and yield spreads. I will now come to the major decisions of the MPC and the RBI. The MPC met on the 3rd, 4th, and 5th of December to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. Consequently, the STF rate under the LAF shall stand adjusted to 5% and the MSF and bank rate to 5.5%. The MPC also decided to continue with the neutral stance. Moreover, in view of the evolving liquidity conditions and the outlook, the Reserve Bank has decided to conduct OMO purchases of government securities of 1 lakh crore rupees and a 3-year dollar-rupee buy-sell swap of $5 billion this month in December to inject further durable liquidity into the system. I shall now briefly set out the rationale for the decisions of the MPC. The MPC noted that the headline inflation has eased significantly and is likely to be softer than the earlier projections. This is primarily on account of the exceptionally benign food prices. Reflecting these favorable conditions, the projections for average headline inflation this year and Q1 next year have been further revised downwards. Core inflation, which had been rising steadily since Q1 last year, eased at the margin in Q2 this year and is expected to remain anchored in the period ahead. So both headline and core inflation are expected to be at or below the 4% mark during the first half of next year. In fact, the underlying inflation pressures are even lower, as the impact of increased prices of precious metals in this inflation number is about 50 basis points. Growth, while remaining resilient, is expected to soften somewhat. Thus, the growth inflation balance, especially the benign inflation outlook on both headline and core, continues to provide the policy space to support the growth momentum. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 5.25%, and the MPC also decided to continue with the neutral stance. I will now spell out in some detail our assessment of growth and inflation. First of all, growth. Real GDP registered a 6-quarter high growth of 8.2%, as you are all aware, in Q2. This is underpinned by resilient domestic demand amidst global trade and policy uncertainties. On the supply side, real GVA expanded by 8.1%, aided by buoyant industrial and services sectors. Economic activity during the first half of the financial year benefited from income tax and GST rationalization, softer crude oil prices, front-loading of government capital expenditure, and facilitative monetary and financial conditions supported by benign inflation. High-frequency indicators suggest that domestic economic activity is holding up in Q3. There are some signs of weakness in few leading indicators. GST rationalization and festival-related spending supported domestic demand during October, November this year. Rural demand continues to be robust. Urban demand is recovering steadily. Investment activity remains healthy, with private investment gaining steam on the back of expansion in non-food bank credit and high capacity utilization, which is of the order of about 75%. Merchandise exports declined in October amid subdued external demand, accompanied by softer services exports. On the supply side, agricultural growth is supported by healthy kharif crop production, higher reservoir levels, and better rabi crop sowing. Manufacturing activity continues to improve, while the services sector is maintaining a steady pace. Looking ahead, domestic factors such as healthy agricultural prospects, continued impact of GST rationalization, benign inflation, healthy balance sheets of corporates and financial institutions, congenial monetary and financial conditions should continue to support economic activity. Continuing reform initiatives, moreover, would further facilitate growth. On the external front, services exports are likely to remain strong, while merchandise exports face some headwinds. External uncertainties continue to pose downside risks to the outlook, while speedy conclusion of various ongoing trade and investment negotiations which the government is undertaking with various countries and jurisdictions present upside potential. Taking all these factors into consideration, real GDP growth for this year is now projected at 7.3%. This is up by about 0.5% from our earlier projections. Q3 is projected at 7% and Q4 at 6.5%. Real GDP growth for Q1 next year is projected at 6.7% and next year at 6.8%. The risks are evenly balanced. I will now move to inflation. Headline CPI inflation declined to an all-time low in October 2025. The faster than anticipated decline in inflation was led by correction in food prices, contrary to the usual trend witnessed during the months of September and October. Core inflation CPI remained largely contained in September-October despite continued price pressures exerted by precious metals. Excluding gold, core inflation moderated to 2.6% in October. Overall, the decline in inflation has become more generalized. Turning to the inflation outlook, food supply prospects have improved on the back of higher kharif production, healthy rabi sowing, adequate reservoir levels, and conducive soil moisture. Barring some metals, international commodity prices are likely to moderate going forward. Overall, inflation is likely to be softer than what was projected in October, mainly on account of the fall in food prices. Considering all these factors, CPI inflation for this year is now projected at 2%, again about 0.6% downwards from our earlier outlook. Q3 is at 0.6% and Q4 moves up to 2.9%. CPI inflation for Q1 and Q2 next year are projected at 3.9 and 4% respectively. I may, however, add that the underlying inflation pressures are even lower as the impact of increase in price of precious metals is about 50 basis points. The risks are evenly balanced. I will now draw your attention to the external sector. India's current account deficit moderated from 2.2% of GDP in Q2 last year to 1.3%. This is a decrease of about 0.9% in Q2 this year on account of robust services exports, which continue to do well, and strong remittances. In October 2025, merchandise exports contracted YOY, whereas merchandise imports continued to increase for the second consecutive month. This resulted in widening of the trade deficit. Healthy services exports coupled with strong remittance receipts are, however, expected to keep our current account deficit for this year modest. On the external financing side, gross FDI to India increased at a robust pace during the first half of the year. Net FDI too increased significantly due to a decline in repatriation despite a rise in outward FDI. FPI to India recorded net outflows of $0.7 billion this year so far, basis figures till December 3, primarily due to outflows in the equity segment. Flows under ECB and non-resident deposit accounts moderated as compared to last year. As on November 28, 2025, India's forex reserves stood at a healthy $686 billion. This provides robust import cover of more than 11 months. Overall, India's external sector remains resilient. We are confident of meeting our external financing requirements comfortably. I will now talk about the liquidity and financial market conditions. System liquidity, as measured by the net position under the LAF, stood at an average surplus of 1.5 lakh crore rupees for the period since the MPC last met in October. Money market rates have remained largely aligned to the policy repo rate, which was 5.5%, amidst comfortable liquidity conditions. G-Sec yields have remained range-bound since the last policy. In response to the cumulative 100 basis points cut in the policy repo rate, the weighted average lending rate of scheduled commercial banks declined by 69 basis points for fresh rupee loans during this period. In fact, the interest rate effect is even more at 78 basis points. The moderation in the weighted average lending rate of outstanding rupee loans has been to the extent of 63 basis points, which again is very satisfactory. The transmission has been very broad-based across sectors. On the deposit side, the weighted average domestic term deposit rate on fresh deposits has declined by 105 basis points, while that on outstanding deposits has softened by 32 basis points over the same period. I would like to take this opportunity to reiterate that we are committed to provide sufficient durable liquidity to the banking system. We continuously assess the durable liquidity requirements of the banking system, which happens due to changes in currency in circulation, forex operations, and reserves maintenance. Going forward too, we shall continue to do so. And after reviewing the liquidity situation and the outlook, as mentioned earlier, we have decided to conduct OMO purchases of government securities amounting to 1 lakh crore rupees in this month. Moreover, we will also be conducting a 3-year dollar rupee buy-sell swaps this month. The details will be notified separately later today. We are hopeful that these measures will ensure adequate durable liquidity in the system and further facilitate monetary transmission. I would also like to clarify that injection or absorption of liquidity through purchase or sale of government securities under OMOs and that through operations under the LAF, which is VRR or VRRR, which are of short-term duration, serve very different purposes. While the objective of purchase and sale under OMO is to provide or absorb durable liquidity, the purpose, which is long-term, and the purpose of repo operations is to manage transient liquidity, which is of very short nature, so as to align the operating target, which for us is the weighted average call rate or the Walker, to the policy repo rate, which now stands reduced to 5.25%. So it is quite possible that on the one hand, we inject durable liquidity through purchase of government securities under OMO, while simultaneously withdrawing transient liquidity through a VRRR operation on the other hand. I would further like to reiterate that the primary instrument of monetary policy is the policy repo rate. It is expected that changes in the short-term interest rates will transmit to various long-term rates. At the same time, the primary purpose of OMOs is to provide sufficient liquidity and not to directly influence G-Sec yields. I will now talk about financial stability. The system level financial parameters related to capital adequacy, liquidity, asset quality, and profitability of the scheduled commercial banks continue to remain robust. Similarly, the system level parameters of NBFCs too are sound. They have adequate capital position and they have improved gross NPAs. The total flow of resources to the commercial sector has been strengthened. This is bolstered by greater non-bank intermediation. In the current financial year so far, the total flow of resources was more than 20 lakh crore rupees, precisely 20.1 lakh crore rupees. This is against 16.5 lakh crore rupees in the corresponding period of the previous year. Outstanding credit from bank and non-bank sources put together increased by 13% year on year. Bank credit too has seen an uptick. The latest number that we have is 11.4%. Sector-wise data reveals that growth was supported by sustained lending in retail and service sector segments. Industrial credit growth also firmed up, aided by buoyant credit flow to the MSMEs. Large industries too recorded an improvement in credit growth. Now, before I conclude, I have one additional measure to announce. You are all aware we have been focusing on improving customer services. We have taken a large number of measures in this regard. Re-KYC, financial inclusion, Aapki Punji, Aapka Adhikar campaigns are some of the initiatives taken in association with other stakeholders, including Government of India, Ministry of Finance. Earlier in the year, we reviewed our Citizens Charter too. We made applications for all our services online. We have the Prabha portal. Some 204 services are online over there. We are publishing the summary of our monthly disposal and pendency of various applications on the first of every month for the last 3-4 months now. And I'm happy to note that more than 99.8% of the applications are disposed of within the stipulated timelines given in the Citizens Charter. However, in the recent past, as a result of inter alia receipt of a large number of grievances, pendency with the RBI Ombudsman has increased. I therefore exhort all regulated entities to kindly keep customers central in their policies and operations, improve customer service, and reduce grievances. Further, in this regard, we propose to hold a 2-month campaign from 1st January next year with an aim to resolve all grievances pending with the Ombudsman, with the RBI Ombudsman for more than a month. I elicit the support of all regulated entities in this endeavor. Let me now conclude. Despite an unfavorable and challenging external environment, the Indian economy has shown remarkable resilience. It is poised to register high growth. The headroom provided by the inflation outlook has allowed us to remain growth supportive. We will continue to meet the productive requirements of the economy in a proactive manner while ensuring macroeconomic stability. Thank you, Namaskar, and Jai Hind.